Welcome to Gold Silver Pros.
Hey everyone, this is 𝘎𝑘𝙗𝑎𝑛𝑐𝑒 with �goldsilverpros.com. We're doing a late edition of the weekly market wrap this week because due to the polar vortex and what it did to Texas with part of the grid being down, internet being down, a lot of areas, water pipes being busted, I was unable to bring you the weekly market wrap on Tuesday, but we're doing it today. And it is January 18th, 2024 as we do the reset on the date. There's so much to talk about today. In fact, I'm going to try my best to distill it down to what's important, but there is so much freaking stuff going on that if I really talked about all this thing could be 2 hours today. So I'm just going to kind of touch on a bunch of things. I'll give you the normal goal report we do. I'm going to talk about what I think for this week are the most impactful stories, but just know that there's so much going on that if I don't cover it, it's just because, like I said, I could do a live broadcast for 4 hours. I mean, political, cultural, economic. And I said it, 2024 was going to be a turbulent year. And oh my God, we have started off January with so much going on. It's exactly pretty much what I said from that standpoint. So let's get into it. I'm going to start with the economic data as I always do. Looking at the economic data from last week, consumer credit, and I mentioned this with Dave Kranzler on last Thursday's video, consumer credit, second highest amount of revolving credit ever taken out by consumers in the history of the United States. The first time that happened was during COVID. So the only other time that consumers lived on credit was when the economy was completely or almost completely shut down in 2020 because of the pandemic. Okay, because of that, there was a lot of credit usage, which we all knew back then, and consumers had some time to pay it off. The government gave away some free money. So that wasn't quite as big a deal as it is now. Now we don't have the economy shutting down. We have a quote unquote normal economy, supposedly some positive GDP growth. The government thinks everything's, not rosy, but good enough right now that they're not calling it a recession, but consumers don't have money. And again, the second highest revolving credit, over $19 billion in November ever for consumers. And it was for holiday shopping, but it was also just to survive. That's the biggest statistic. A couple other things, CPI spiked up just a little bit, 0.3%. So we're back into the inflationary wave. I'm going to show you a chart about where we probably are in this stage of inflation in the economy. Given what happened in the past, we're going to compare it back to the 70s and that inflation. I don't know if it's exactly going to be the same, but it's a good guide as to where we are. But we're starting to see round 2 of inflation. And I think that that's going to have a really big impact on the economy going forward for the next 2 to 3 years, because I don't know if the Fed's going to be able to control it. The Fed has said that they plan on cutting this year. I don't know if they're going to be able to do it. I think that they're seeing mixed signals in the economy and they want to cut to ease to get the businesses back on track because what we've seen in earnings reports was negative in fourth quarter. We've seen the banks, for example, Citi announced they would cut 20,000 jobs, mostly middle management or mostly management roles, some executives, to cut between 2 and 2.5 billion off of their payrolls through 2026. In a cost savings mode, Wells Fargo has announced that they're scaling back as well. The large tech companies are doing okay. Microsoft and Apple are doing okay. The rest of the tech sector seems to be in a bit of flux. So overall, earnings reports not super positive during the fourth quarter. And I think that's because the consumer is really suffering. We go back to last quarter. We did have positive GDP prints the last 2 quarters of the year, 5.2 and 4.9, I think, positive percent. But most of it was on credit. Most of it was on revolving consumer credit or buy now, pay later, or government spending on credit. So what Dave and I talked about last Thursday was when you spend on credit, that pulls forward consumption from 2024 into 2023. And now we got to pay it back. So that's part of what's going to make 2024 a little bit more back and forth and up and down and a little bit more haywire, if you will, with the economy is we pull forward consumption and now we're going to pay it back with interest. And that's going to be an issue. Overall, an interesting commentary from Michael Barr. He's the Fed Vice Chair for Supervision. And he was talking about how they're going to let the Emergency Bank Loan Funding Program, the BTFP, that came out when the bank failures happened last spring, last March, April, May, that time frame, if you remember, second, third, and fourth largest bank failures in history occurred. The Fed came out with this bank term funding program. They said the banks can pledge any collateral they want and they'll give them money. Okay, that ends in March of this year, the 1-year anniversary, but they're going to allow people that at any time from last March to this coming March sign up for that program to have the extra year to pay it off. So that bank term funding from 2023, they kind of bailed out the banking system. from the Fed doesn't have to be paid back until 2025. Now, supposedly they're going to end the program, so you can pledge collateral and take loans from the Fed up through March of this year, 2024, and then you'll have the 1 year to pay it off. And they're going to extend that for everybody. So if you had taken it March 2023 at the beginning, you still have until 2025 to pay it off, as I understand it. And he's saying that the bank term funding program worked, but originally it's supposed to be 25 billion. It went up to 141 billion. It expires on March 11th. And according to Barr, he says, quote, "The program worked as intended. It dramatically reduced stress in the system very quickly. It was highly effective," he said, adding it really was established as an emergency program. And it did. It stopped probably a bigger run on the banks, but it has to be paid back. And the question is, do the banks have the money? With Citi laying off and with the expectation that Wells and maybe Bank of America, some of these other banks may start laying off, and you may have internationally based banks originally based in Europe or other places also laying off, it's a question of whether banks that took money from that U.S. program are going to be able to pay it back. And I think, that's really in question right now. So I'm not sure that I believe that that will happen. But that was the other interesting thing I saw. Now, fast forwarding to this week, since we're doing this on Thursday, we've had more data come out. So on Tuesday, a couple of days ago, Empire State Manufacturing Survey came out. That's manufacturing for the Northeast, especially in New York. That plummeted a lot. It printed at negative 43.7 on expectations of being -4. Any negative number is a slowdown or a retraction. They thought maybe a minor slowdown. This cratered. The last 2 months, it's plunged over 43 points. It plunged 29.2 points to get to -43.7 last month, but the month before it had also plunged something like 18 or 19. So it's absolutely abysmal. Looking at the manufacturing indices for the rest of the country, manufacturing is abysmal in the U.S. So any thought that the U.S. had been reshoring manufacturing and that would give a boost to the economy hasn't happened enough to offset the loss of manufacturing. So manufacturing is collapsing right now in the United States. And when I say collapsing, I mean collapsing. We're not making any of our own stuff. And what's going to happen is that's going to negatively affect import versus export ratio known as the current account balance. The current account balance is a measure of how much we're sending out to buy stuff versus how much people are sending in to buy our stuff. And people are going to be sending a lot less in to buy our stuff, which means we're going to be sending more out, which means we are going to have probably more inflation, a weaker dollar, and also we're going to owe more money because we're spending more than we're getting in. So from a country basis, not like an individual basis or a corporate basis, but from a countrywide basis, we're running deficits, and that's going to continue. And we're not going to be able to manufacture or build our way out of it like we did after World War II. We don't have the base. It's collapsing right now. So that potential for us to sort of manufacture our way back into a positive economy or grow our way into a positive economy, that base in manufacturing is absolutely a mess right now, is an absolute mess. And so that's what tells me that for the next 2 to 3 years, because we lack that ability to sort of rebuild from within, we're going to go through a lot of economic pain. And that's why the manufacturing surveys are still so very important. Industrial production tipped up just a bit. Capacity utilization stayed the same. But overall, when you consider inflation, we've had no growth in the economy basically whatsoever. Now going on to the markets, bonds had spiked. It was funny. The headline at CNBC was the bonds had spiked because we had a positive labor report. Well, the bond rates won't go up when you have positive labor report. They should go down because it should reduce the risk. Interest rates on bonds are a measure of risk. When bond rates go up on the 10-year, as they did, you would expect that the risk is going up. And so the headline at CNBC, I don't know if it's intentionally misleading or just a bad headline, but when you see positive aspects of the economy, but the bond rates go up, first of all, you have to go and question whether that aspect is positive. And if we looked at employment last week, the last employment report at the beginning of January was not great. Yes, there were jobs created, but full-time jobs dropped by 1.5 million. Most of the ones that were created were part-time, and we have more people, additional, I think 22,000 people working multiple part-time jobs than the previous month, trying to make ends meet because they lost their full-time, they lost their benefits. So now more people are working 2 jobs. So that's why bond rates are up. As we looked at the cryptocurrency complex, Bitcoin had a nice run. It still may be on that run, but it's retracted a lot today. As 1 p.m. Central Time, when I'm looking at Bitcoin, it's down $1,263.22 to 41,421. Most of the cryptocurrencies are trading down. Gold has also been selling off. We'll talk about gold here in a little bit when I get to that part of the program. So a lot of alternative assets are selling off. It's this false narrative that the U.S. economy is doing well, but I think that's temporary, and I think that's going to change and turn around. I think both Bitcoin and gold are going to do a lot better. An article from Ryan McMaken via the Mises Institute Yet another recession flag. Net saving is negative. I'm just going to read you a couple of quotes from this article. Quote, net saving as a percentage of gross national income has been negative since the first quarter of 2023. So in 4 consecutive quarters, net saving has been negative as a percentage of gross national income. People are not saving anymore. And I just talked about the credit problems and people buying on debt. So not only are they not saving, but they're going backwards and buying on debt, which you have to pay back later with interest. Further from the article, quote, the current period of negative net savings is only the 3rd time that net saving has gone negative in more than 75 years. Ladies and gentlemen, if that's not a recession indicator, I don't know what the hell is. Every single long-term indicator I look at is flashing red right now. Every damn one. There's not a single one I look at and say, oh, we're going to be okay. So all this Fed speaking garbage about a soft landing, we're not going to have a soft landing. We're not going to land. We're going to go through. We're going to fall through the floor. We got a rotten foundation. We're falling through the floor. We're a mess right now. Further from this article from Ryan McMakin at the Mises Institute, quote, looking back to the 1940s, we find that the overall trend in net saving increased during the post-war period of economic retrenchment in the 50s and 60s. This is baby boomer time. We know how the baby boomers did. They had the most wealth creation basically in the history of the United States. That's not where we are right now. The millennials and Gen Zers of my generation, Gen X, and the baby boomers who hold all the assets. We're not going there, all right? This is a flight to safety during really tough economic times. That's where we're going. Further from the article, quote, with the guns and butter era of the 60s, however, net saving went into decline and the general downtrend has continued ever since. But this is only the 3rd time it's gone negative in 75 years. That's not good. Other stories from the week, EU president at Davos. EU president demands globalist control over all information. Here we have the controls coming over information, over free speech. Quote from Steve Watson via Modernity News. Quote, President of European Commission, Ursula von der Leyen, which, by the way, is not elected, she was appointed, addressed elites at the World Economic Forum in Davos Tuesday, calling for overarching globalist control over flow of all information of the digital age. Quote, the top concern for the next 2 years is not conflict or climate. It is disinformation and misinformation, von der Leyen proclaimed, adding, quote, the boundary between online and offline is getting thinner and thinner, and this is even more important in the era of generative AI. Further quote, addressing the elite as excellencies and personally naming Dear Klaus Schwab in her introduction, von der Leyen further called for the development of a new global framework for AI risks and a vow to drive global collaboration to prevent the spread of misinformation. And according to the article author, quote unquote, information they don't want you to know about. So censorship is probably coming to a lot of places. I don't know where this is going to go in the US, but expect as we get further down into the economic problem that a lot of free speech is going to be monitored, even possibly prevented on a lot of platforms. So that's definitely something that we want to pay attention to because it's a risk to our Constitution. So not only we're getting into an era of heavy economic risk, we're getting into era of heavy political and cultural risk as well, which I'm going to get to here in a moment. All right, we're about to get into the rest of, I wanted to make a note. Trump came out and said this week, as he's running for presidency and winning the Iowa caucus in the landslide, that he would not allow CBDCs. So we've had DeSantis, who's probably second in the running for the Republican nomination, at least right now in early voting, because he had 21% in Iowa. He says he'll oppose CBDCs. He actually signed legislation in Florida to do that. Now Trump has said it. So the 2 leading candidates on the Republican side have said they're going to oppose the central bank digital currencies here in the United States. Politically, this is very big because it puts a target on their back. Definitely the Fed is headed towards central bank digital currencies. 130 countries are. The BIS, international groups want us to do that. So I think there's a showdown coming in the currency system in the political landscape this year. And it'd be interesting to see, what happens, or we'll continue to follow that. All right, we're going to get into sharing some information. I'm going to go back to a chart that my friend Tavi Costa of Crescat Capital put out. And the good thing is every once in a while on Twitter, and you can see him here on Twitter if you're interested, go follow him. He'll move the marker for where we are. So if you see in blue down here where it says you are here, he's saying we're in the middle between the first wave of inflation and the second. And this is basically the inflationary wave that we saw in the 70s. This is an historical pattern that he's graphed out. This was 1966 and 84 when we had that blow-off inflation in the late 70s to the very early 80s before Volcker raised interest rates so high. He's saying we're between first and second wave. The inflation data I've seen seems to support that because it's ticking up, but not much. And so we may have another secondary wave of inflation that lasts a year or two. And then if form continues, that'll continue for 6 or 7 or 8 or maybe 9 or 10 more years, even after that, depending on how bad the situation is. So we're not out of the woods, most likely, on inflation. I think we're so far following this chart now here in 2024. And I think he's right where we are in 1972. So it's about a 50-year pattern. Well, think about fiat currencies. How long do they last? About 40 to 50 years. So it looks like, yes, this is the pattern, because back in the 60s and 70s, in 1971, we came off the gold standard. And then we started to have that inflation. Well, what's happened now? Well, now we're talking about de-dollarization, move away from dollar as the global reserve currency. And so we're moving to a new currency regime. So I suspect that we'll have the same pattern, because once again, we're changing currency regimes. From the 60s and 70s, we changed from a gold-backed dollar to a fiat dollar. And now we're changing from a fiat dollar to worldwide central bank digital currencies. And so I would expect during that regime change of currencies, we're going to get higher rates of inflation. I don't suspect it's going to be any different this time. So I think that's a great chart to follow. So if you're preparing for what's coming, don't think that the temporary pause in inflation is going to last. It's going to kick up and get a lot worse. All right, on to the gold overview. Looking at volume and OI on a gold chart. Gold and silver are very interesting. So I'm going to spend a little bit of time on those today, really focusing on a different on the COT report and what's going on to try to explain why gold's trading down, why it traded up and why it's trading down this week. So, but just looking at the open interest, we've seen a lot more open interest of the last week. And again, I'm going to say it again, every time we see a spike in trading, which is signified by open interest, the amount of contracts open, both long and short, when we see a spike, that usually means there's a short or a decrease in price in gold and silver. So when there's more trading, it's usually short paper coming in. When we saw the rise here, when the trading was, I would say, moderate in the gold market, and as soon as it ticked up, we saw the price come down. Short paper is coming in. I'll show you who owns that short paper. Just looking at the data, February has now become the big contract month, although that's rotating into April. Again, this is a futures market. You buying paper right now for what you think the price will be, whether more, which you would go long, or less, you will go short. It's futures markets, not the physical market. Even though this is where prices are determined, it is not the physical spot market. The spot price is determined by derivatives, not physical trading. So if you want to dump a bunch of paper and drop the price, you can do it. And this is how it's done. And we can clearly see that that is what's happened. We'll get into that COT report here in a moment. But most of this was short, which I'll show you. Some of it is long. We'll get into that. And the other thing that I'm interested in on this report is EFP. That's exchange for physical. That's right here. An exchange for physical trade, EFP, is a privately negotiated and simultaneous exchange of a futures position for a cash position. And it's moving over to the UK market, typically, if you look at the CME Group's website and how that's been explained. So 5,384 contracts. Now, there have been a lot, but that's high for a single day. That's yesterday's data. If we look back at Tuesday's data, another 4,000. If you look at last Friday's data, 1709. The markets are closed, of course, on Monday for MLK Day. So in the last week, we've seen a tick up from about 1,000 to 2,000 contracts a day to 4 to 5. You see 4 here on Tuesday. You see 5. So what is that? People are hunting for differences in the price of gold between the two markets, but they're looking for physical as well. I'm going to do settlements really quickly. The only reason I do settlements anymore is just to let you know how the price is determined. Most of the trade was done on the February contract. You can see the volume's 154. It's the biggest in this column. So we go to February where the price is likely determined, and it's been up 15 bucks. This is actually today's data, interim data through 1 p.m. Central Time, or I'm sorry, 1 p.m. Eastern, Central Time, excuse me. So it's been up a little bit today, but on Wednesday it got slammed down 23 bucks. You can see that right there on the February contract. On Tuesday it got slammed down $21. You can see that on the February contract. Friday up 32. So the pattern is reversed. What we're seeing at the end of the week is gold price rising, and at the beginning of the week it being slammed down. Usually on Friday the slam down kind of starts, or a little bit of drift, and then you'll see it Sunday night heading into Monday. The patterns change a little, and I think what's happening is there's a battle on the market east to west, and east is basically trying to get rid of the stranglehold that the west has, and so we're starting to see a little bit of pattern changes in the way that it's trading. Let's look at the physical for gold for a moment. This is depositories. So you've got the COMEX right here in the top line. You've also got ETFs, funds, and e-funds. So ETFs, funds, and e-funds, some of this is stored in the US, some is stored in Europe, most of it in the UK. But that gives you an idea of the Western gold market, mostly the Western gold market. And so those are some of the biggest gold markets. That's what we pay attention to. So I want you to look at this number right here. The last monthly change for registered gold coming off of the commodities exchange here in the United States is over 1 million ounces. But most of that, 887,000 ounces, was done in one day last week. That's one day last week. One day last week, 887,000 ounces came off a registered. Why does that matter? This registered category here, this top line, is what's actually traded on the market. Eligible down here is just private storage. You could trade it on the market, but you got to designate it. You got to take a step. You got to say, it's kind of like putting your house for sale. Your house is there, it's eligible to be sold, but you haven't contacted the real estate agent and put it on the MLS. Same thing with gold. The registered is when it's on the MLS equivalent. It's got, it's got the tag on it that we're actually going to put it up for trade on a contract. The rest of this ineligible is really just private, and it's not really directly for sale. So this is the one we pay attention to, registered, in terms of liquidity. This top line is liquid gold in the US on the big commodities exchange. And in one day, 887,000 ounces came off. Somebody just bought a crap ass ton of gold off the industrial market. That is millions upon millions of dollars of gold in a day. Huge. Big players are taking gold off the industrial markets in the US. Massive amounts at one time. I want to know who it is. I don't know who it is. They're not going to tell us, but massive. Overall, about an additional the last 4 weeks, 900,000 flowed off of the rest of the world market. So again, if you look at the chart, the last 3 years, gold's flowing off. There was a little bit of a spike in 2022, and then it came right back down, So people are taking gold off the Western markets. A lot of it's flowing east. That has not changed. But this single day of almost 900,000 ounces was stupid, ridiculous. Some big player or big players came in and just gobbled up a whole bunch. And they gobbled up a whole bunch when gold price was what? Falling, not rising. Actually, I think it was earlier this week, excuse me. So when the gold price fell, let me get this correct, the last few days is when that big amount came off. So gold price tanked, they took the physical. That's important to understand. If you can move the price using paper contracts and derivatives, which cost pennies on the dollars to run, then you can go take the physical at a cheaper price. I've seen this happen over and over for the last 6 months. Somebody is tanking the price of gold, and somebody else, or maybe the same party, is taking the physical at a reduced rate. Okay. And this has been going on, especially the last 6 months, but over the last 3 years. Every time we have a big price drop, somebody takes the physical off. Physical is coming out of the world market. Somebody's benefiting or using the derivatives market to tank the price of gold and silver and taking it off. It's clear as day, and the data, I don't know what to say. All right, on to silver, same thing. If you look at volume and open eye, a little bit of spike, guess what? The price fell. Every time you see these bars jump up, it's almost always additional short volume coming in, and you see the price fall. And what do? Well, they take it off the market. How much silver are they taking off the market? Well, they're taking a bunch. Off of registered liquid silver in the last 4 weeks, almost 4 million ounces. But most of that recently. That whenever the price goes down, they take the physical off. It comes out of the exchange. Okay, you see the pattern, gold and silver. But in addition, around the world is about another 900,000 ounces. And overall, the overall stocks come down. Well, let's look at what silver's trading. If you look at silver, there are some EFPs. And what is an EFP again? It's exchange from the US to the UK, futures contract for an OTC contract. You need to know all that. You just know that somebody's hunting for silver. A little bit to a lesser extent than gold, but they're still hunting. Healthy trade here on the data, 102,000 contracts. March, not February, is the dominant contract right now for silver. That's slowly rolling into May. As you can see, May has some healthy contracts, but right now it's March. Makes sense. That's what's going on. We look at the settlements. So as of today, this is as of today at 1 p.m., January 18th. You can see right here. This is what they call interim or preliminary data. It's not full day's data for today because we're not done trading. But this just came out about 15 minutes ago. We're up about 15 cents, 14 cents on silver, 13 cents on the March contract, a little bit more on the near-term contracts. So silver's up a bit today. What about Wednesday? Slammed down 42 cents. Tuesday, slammed down 23 cents. Remember I said the pattern at the beginning of the week usually was it rises and it falls later in the week? Well, we're later in the week and it's rising. And in the middle and the beginning of the week, it was falling. So the patterns have changed. I believe, ladies and gentlemen, there's a war going on between East and West for gold and silver. And I think the East is coming in and basically screwing up the way that the markets used to be controlled by the bankers in the West. And I think that's causing violence in gold and silver prices. And again, whenever you get close to recession and whenever you get close to the next big bull run in gold and silver, precious metals, when that recession hits, you see these violent price swings. And what that's caused by even more and more is not the retail crowd in the US buying, gold ounces. It's sovereigns and other big entities, big banking entities, wealthy entities arguing the price in the markets. And that's where you see the violent price swing. So if you're a small guy and you're buying gold and silver and you see it move up and down, don't worry about it. It'll work itself out. Gold's going to continue to go up if we head into recession and have more bank failures. Don't worry about the volatility. Use the dips to buy. That's my recommendation. Of course, be your own financial advisor or contact a financial advisor. Do not use anything I say here as advice or trade off of it. Do your own research. I have to put that disclaimer up. But just know that that's the general pattern. So don't worry about that pattern too much. But overall, silver's trading up. Friday's data and Thursday's data, it was trading down. So silver's very volatile. A lot of that is industrial trade coming in. All right, we're going to the CFTC report now. This trade as of like now or yesterday, most of this data is yesterday, some's today, that you saw on these 4 charts. This commitment of traders where we actually get who's doing what is about a week to 10 days late because they gather the data, they print it. CFTC doesn't have direct access to all of it. Some they're collecting. It's behind the curve. But it does tell us who did what. So leading up to January 9th, where the prices were rising before the last 5, 6, 7 days where they've been falling. When you saw that gold and silver price rise through January 9th, we had what? We had dumping of short contracts. So this is in silver through January 9th, silver. The swap dealers or the bullion banks, which I always talk about, dumped shorts. When you dump shorts, that puts you net long. That takes pressure off of the price going down and it puts pressure on the price to rise, or it allows the price to rise, the rest of the market to raise the price. And so what happened was that's why silver went up. We don't have the data for this past week. We won't get it for a few more days. But when we get it, probably Friday or Monday, usually Friday, we'll see that now the price is coming down. More than likely, the bullion banks probably added shorts. That's always the pattern, or at least 99% of the time that I can tell that we're covering this last 4 to 5 years. Okay, so now you know how the market works. The swap dealers drive the pricing. Now, some people could say, well, yeah, but somebody's got to take the swap dealer's contract. Yes, but it's when you dump the contracts, at what price you dump them, that moves the market. Because let's say the banks or anybody else comes in and says, I want to put a short contract out there for silver 50 cents below its price right now. And if you dump a bunch of paper out there without having to back it up with physical, you just do a bunch of naked short selling. What happens is the rest of the market sees that and they say, oh, they're offering paper cheaper. I'm going to take that paper. And once they conclude that, the price comes down. That's how that market works. If you offer a bunch of paper, people are more likely to trade down because that is the market. The market is the paper. So if somebody comes in, just dumps a bunch of paper, it drags that market down. Now, if the longs decided not to take it and not to agree to it, it may not crash the price as much, but they do. Okay, they take the other side of it. It's a very, liquid market here in the US. A lot of people play in this market. A lot of international people play in the market. So there's enough liquidity for the bullion banks to drop the price, and it's what they do. Moving on to gold, same thing. This is gold through January 9th. This is before the recent price swing down. This is explaining when the price went up prior to the most recent week to week and a half down. They dropped 19,000 contracts off of gold. That released 19,000 contracts of 100-ounce gold into the market, which allowed the price to rise. So through January 9th, what's happening to the price it rose? How do I know that? It's on the chart. This is the price of gold rising between about the 7th and the 9th. And this is the price of silver rising a little bit less. And this is a commitment of traders. They canceled 18,000 of their short contracts through January 9th, which allowed the price to rise through January 9th until it fell. You see how that works? There's about a day delay actually in there. So that's how that works. The bankers dump shorts, price goes up. Bankers add shorts, which we'll see in the next report, price goes down every single time. And when you see this spike up, this is shorting. What's happening to the gold price right now? Well, today it's up a bit, but the last few days it's been going down because increased paper, which you then see here. Okay, does that make sense? So now I'll explain how the dynamics basically of that work. And now I'm going to go to the Chinese market just for a minute. In the Chinese market, you're looking at for the December contract 2024, you see an $88 premium in China over the US. I believe that's a more realistic gold price. And in the June contract, you see it up $40. Why? Shanghai settled more physically. That's why I always bring this out. This is as of today's data right here, 118. So the contracts, the equivalent contracts to the COMEX is trading higher in the Asian market by quite a bit for June and for December, because it's a more physically settled market, and that physical demand is dragging up the price. So if we ever get really high physical demand in gold and silver in the US, higher, yes, the price will rise, because we see what happens in China. This is a higher physically settled market, and the prices are higher because more people are buying the physical. If we ever get more physical buying in the United States, the prices are going to go higher here. It's going to put upside pressure on the people in the spot market to do something about it. All right. Now, before we get into a couple more stories that I have to end up with, I'm going to talk about Bitcoin for a sec. So I did this post a few days ago on Bitcoin, and I said that here's the thesis. Either you agree or disagree, and I just put it out there for people to agree or disagree. I said Bitcoin ETFs killed, when the ETFs came out, they were approved, I guess, for Bitcoin, meaning institutional money can now bid on Bitcoin through an ETF structure, okay? Bitcoin ETFs killed any chances it had of remaining independent and uncontrolled by the financial system or the financial elites or the financial controllers, whoever those are, the participants, the big dudes in finance, right? So I said, is this true? Do you agree that when the ETFs came out, it ended the independent nature of Bitcoin and the price, and it added price controls to Bitcoin? 82% said you agree, 17.3% disagree. Now, I am a gold silver channel. Those could be possibly skewed, but I think there is awareness out there, at least in honest money circles, that when you put a financial market on top of something, you put an ETF on top of something, it allows control and suppression of price movement. And that's what happens in gold. I just got through talking about the derivative market in gold and what happened. They've controlled the gold price. Now, eventually that can break with physical demand, but it puts controls in place until you have that robust physical demand that comes about as a result of financial calamity, economic calamity, so on and so forth. And that's what's going to happen to Bitcoin. Bitcoin's going to become more controlled because you're going to have big financial money in it. Doesn't mean that Bitcoin couldn't possibly be a good investment, but just look for more controls. And because it's ETFs, you're going to have the Securities Exchange Commission get involved, other regulatory agencies get involved. They're going to put rules around it to become less independent, less decentralized. So the whole thesis around Bitcoin, BTC, and a lot of the variants in the crypto space was that they would be independent, decentralized, not controllable. Well, now they just got more control because you're going to have regulation and you're going to have money flowing in that's controlled by what? The existing financial complex that controls stocks, bonds, everything. Okay. So I think this is going to be probably negative overall for Bitcoin in terms of Bitcoin's ability to independently price itself as a currency outside of the existing financial complex. Now Bitcoin is not as decentralized. You could say a node's decentralized, but the market is now not, the price is not decentralized. And you're going to have more regulation come in. So it's not going to be independent. It's going to be dependent upon what? The US government and possibly other governments as well, where those ETFs may trade. So now all of a sudden you've got a different proposition for Bitcoin. I'll be interested to see people that buy Bitcoin, you know, on my channel and other channels, how they feel about this. A lot of people have been very positive about it, and maybe there are some positives that come out of it. But at the end of the day, I think that we've now financialized Bitcoin, much like we've financialized everything else. And I don't think in the long run, Bitcoin advocates are going to be as positive about it. All right, last story for the day I wanted to talk about, probably the most impactful, is going to be what's going on in the Red Sea. I talked a lot about the war and the spending and whether or not we should even be over there. I'm really agnostic as to whether we get into a lot of foreign wars in terms of I don't usually support them. I don't want to spend the money. I don't think it's good for us. We can't be the police of the world, but that's not really what I'm talking about here. I'm talking about what's happening around the African coast, what's happening in the Red Sea, what's happened outside the coast of California and LA and San Fran. Piracy. We had that article about a month ago where I put on Twitter, I didn't put it on YouTube, but I put it on Twitter, how pirates are now stealing boats in marinas in San Fran, and they're stealing cargo outside San Fran and LA, right outside the US. Well, what's happened with the destabilization of the shipping lanes in the Red Sea and in the Middle East because of that Middle Eastern conflict, Gaza Strip, and now some stuff with Yemen and the Houthis and the rockets being launched, is now we have piracy escalating in the Red Sea. That's a key shipping lane where a lot of products come from. For example, a lot of chips that go in to feed Apple products and other large technology firms are not making it. Tesla right now is having to shut production of some of their models, or slow production or reduce production, a lot of their models, and shut down some factory output because they're not getting their chips that come from like Taiwan through the Red Sea or other places through there. They're not getting to their factories because Tesla's not just based, in Austin. They're all over the place. So the supply chain for a lot of technology firms in the US is being interrupted, and it's really affecting that. And piracy is affecting the supply chain. So like we saw in 2020, I expect the re-emergence of a lot of supply chain issues, which what's going to do to the price of things. When you don't have the supply you need, but you have demand, boop, and we've already seen that. For example, I have a battery in my truck. My battery went out because it got really cold. The battery's about 4 years old. It's the original battery of the truck, actually 5 years old, and it died. And it's an AGM glass mat battery. Very expensive normally, about 100, 120 bucks. That battery, yesterday, I had a hard time getting to the store because I couldn't start my truck. I had to Uber my son to school. And then I went all around the city in Uber trying to find a freaking battery for my truck. And it was 250 bucks. And I got the last one in the city that I can tell. I literally called Walmart, Auto Parts Center. I called every repair center I could find. I called every auto store, and I found the last one. I got it in there, and it's working. But that battery is an intelligent battery, because depending on the voltage of that battery, some of my functions turn off. I noticed that my traction control turned off when that battery went low voltage. I noticed that my ability to tow haul was turned off. My skid control and my dimmer lights were turned off. And when I looked it up, those batteries, when they drop below a certain voltage, the computer starts shutting things down. Okay, so there's intelligent contact between the battery and the computer in the system. And so that affected my ability, one, to operate the vehicle safely with all of its safety features. Also, maybe its pollution control systems, I believe, and its traction control systems. But also, I couldn't find the damn battery, and the battery's twice as much as it used to be a year ago. So prices are rising when the supply chain problems are affected. And because of what's going on in the Red Sea, a lot of that trade's going to affect products that you buy every day, whether it be technology or whether it be stuff like car batteries. You're going to see it everywhere. So not only are we going to see the resurgence of inflation, you saw on that chart before where I talked about the 3 waves of inflation. Inflation is going to go up. But in addition, the supply chain is going to exacerbate and make worse and make more dire regular products that we need every day in the supply chain. It's going to cause less supply, more demand, and it's going to spike inflation more. So inflation is not just going to be the money supply. It's going to be the availability of goods that you can buy with that increased money supply, making inflation worse again. Now, likely some of that gets resolved and it brings, it moderates some of that effect on inflation, but I don't think it's going to happen this year because the Middle East seems to be blowing up to me, and it's going to cause major trade issues. It's going to cause more sanctions at one point, and it's going to cause trade flow problems. And piracy in the Red Sea right now is bad. And the operation that the United States put together with its allies to patrol that has fallen apart. A lot of the countries say they're not supporting the U.S. in that and the way that they're doing it. And so right now, Iran's running ships through there. Other states are running ships through there. Pirates, you've got Houthi firing rockets, according to the news. That is an unstable region, and it happens to be the nexus for the flow of goods from the west to the east in many cases, and also to Europe and also to Africa. So expect to see supply chain issues reemerge, just like we had in 2020. It's going to cause major, 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 major issues. And I think that is going to be a huge story for the first quarter of 2024 as a resurgence in inflation and debt and all that, and lack of good jobs and layoffs, but even bigger, the inflation that's coming because of supply chain issues in the Middle Eastern conflict. And that's why every conflict that you get into has a cost. And it's not just the dollar you pay for the missile or the soldier. It's what happens to world trade and what happens to trade agreements and how the world realigns and what you deal with along there. Multiple areas, multiple levels of problems coming to the world economy because of that one conflict that's now expanding in the Middle East. And I'm telling you right now, we're all going to at some point rue the day that we ever got involved in that. And it's not just culturally and politically for the deaths of people that are dying, but it's economically the dollars we're spending, but it's a second and third order effects of how it's going to screw up the world economy and how it's going to realign the world economy and how that may not be all positive for us. In fact, I think a lot of people are pissed off at us and they're not going to come back to the table with the same economic agreements that they had. And that's going to put extreme pressure on the U.S. economy at a time when we can't handle that pressure because of debt and the impending currency collapse that's coming down the road. And that sets up the war about the central bank digital currencies, which I mentioned earlier with Trump and DeSantis, the two leading Republican candidates as of right now that vehemently oppose CBDCs, and the banking system and the governments who want them. And it's going to be striking to see how that amps up big time because of the problems we're going to have in trade and the economy and the wars that we're funding. Again, always issues with wars that you don't see right up front. That's why I always vote against wars unless you have to have them. I don't like the death toll, but I also don't like what happens to the economy for years and years after. Of course, we saw that after World War II. We saw it after Vietnam with the spike in inflation. We've seen it, okay? We're going to see it again. So just be prepared for that. In my opinion, I think this is going to get a lot worse before it gets better. And that's going to exacerbate the turbulence that I've been preaching about and calling that I think is going to happen, not calling for, but calling that I think is going to happen, predicting in 2024. 2024 is going to be so freaking turbulent that I think it's going to shock a lot of people. A lot of you guys are really savvy. You know that. But if you're watching my program for the first time, just know that 2024 is going to be turbulent. And I've got people coming into my store that are buying gold and silver for the first time that have never touched gold and silver. And they're telling me they're worried about the currency. They're worried about inflation. They're worried about jobs. Okay. And they're worried about the state of the world, geopolitical. And they're buying stuff now. So now you're starting the beginning phases of the next bull run in gold and silver. And I'm seeing it in retail. Okay. We had the last couple of months, a lot of people trying to sell back into the supply chain. I heard of one dealer in the Dallas-Fort Metroplex within the last week in one day bought from customers $500,000 in metal. However, at the same time that customers are selling their necklaces and things just to get money to pay bills, you have the people that have money coming in on the retail side saying, oh, I need to buy a little gold and silver. Now they're doing it a little bit less. So net, we got more coming in than going out as a dealer perspective, but that's going to reverse as we go farther into 2024. And that's really what's going on sort of in the retail trade. Now, what I showed you in the gold movements on the ETFs and the COMEX before is more industrial or big money, central bank type of purchasing. The big dudes, that's taking gold and silver out of the system. Retail in the US is not caught up. Retail is still putting gold and silver out of private families back into the system. It's going backwards. It's going back towards dealers, refiners, and wholesalers. But that's going to reverse. And when that retail starts coming back out into the hands of the people, much like the gold's coming out in the industrial market, Katie bar the door, you're going to see gold and silver go absolutely bunker nuts. And that's not that far away. So people are worried about that. I'm telling you right now, it's not as far away as you think. It may take some time this year for that to kick off, but I'm telling you right now, it's going to kick off. And as soon as we have the next bank failure or big corporate failure or enough people get unemployed, and loans start defaulting, I'm telling you right now, gold's going to go absolutely freaking bonkers. And that's going to be the start of the blow-off leg of gold that's probably going to run for a couple of 3 years before it finally dies off. And we get gold back in some sort of regular trading pattern. And I think that starts in 2024 for all the reasons I just talked about on this program, that I talked about Dave last Thursday, that I talked about my 2024 preview, that I talked about my review of 2023. And I'm pounding that message home. Slapping on the table, causing my camera to waver. I cannot stress it enough. We're at the end of this system. It's going to get more volatile, and that's going to change everything. It's going to change everything, and it's coming. It's coming, and it's here. And again, we're in the quickening phase. 11th hour, 58th minute. We got 2 minutes left on the clock, relatively speaking. That 2 minutes could be a few months. It could be a year, but I don't think it's that long. You do not have time to prepare, period. You're going to do it and you want to do it and you decide to do it, you won't want to do it now. And I'm going to put up my little disclaimer, not your financial advisor, but damn, I mean, just look at the data. Like, that's what I'm doing. You do what you got to do, but that's what I'm doing. All right, this is going to do it for the weekly market wrap. Again, to recap, we're doing it on Thursday because of Snowmageddon. Was it part 3 now in Texas? Which knocked out the internet, knocked out water pipes, knocked out the battery in my truck, did a lot of things. We're finally back in the store. We're open. So come see me. I got a big collection coming in today. Somebody's selling off their coin collection. So we've started to see retail come back a little bit. We'll see how that goes. And because I own a retail store, because I'm in contact with wholesalers, I'll let you know how that's going. That may give you some advance warning on if gold's about to go up again, at least in a general sense, not on a daily basis, but are we heading into gold bull market this year? Oh, hell yeah. but I'll let you know the flows in and out of my retail store and others that I know in the area and across the US as to when we think gold's really going to start getting frothy. I think it's still going to be a bank failure, a major economic blowout, major war issue that's going to do it. But we're a lot closer than we were, and we've been in a very, very long time. So those of you who've been doing this for 10 to 15 years like I have, we're here. And I think that for people like me scares the crap out of me, because I don't necessarily want to be here. Even though I sell the stuff, I really don't want gold and silver to really boom yet because of what that means is going on in our lives. But I think it's coming nonetheless. We all got to be adults here and put on our big boy and girl pants and just look at it for what it is. And that's why you come to my channel, because I don't BS around. I tell as much truth as I can. I'm not overhyping. That's what I see in the data. All right, thanks, guys. Until next time, Rob Keates, Gold, Silver Pros. We'll be back at a regularly scheduled time Tuesday night with a weekly market wrap for next week. And we may have an interview next week. We'll see. Till next time.